If you walked into my office today and looked at Berkshire's balance sheet, the first thing that would probably strike you is how much of it isn't in stocks. It's in cash and short-term instruments, earning modest returns while the market headlines shout about new highs. People ask, why on earth would you do that when everything's going up? The honest answer is simple, because everything going up at once is usually a warning, not a comfort. Over a lifetime, patterns start to rhyme. Before every major break I've lived through, there has been a stretch where risk was systematically underpriced. Stories became more important than earnings, and leverage built quietly in the background. In those moments, the wealthy who lasted didn't get seduced by the music. They stepped back from the dance floor and counted exits. That's what a cash mountain represents, not indecision, but optionality. As we edge toward 2026, I see too many indicators flashing the same muted shade of red I've seen before. High valuations married to strained households and governments running experiments in monetary and fiscal policy at a scale no one truly understands. You don't need to know the exact date of a storm to close the windows. You just have to accept that blue skies can change faster than people think, and that the real advantage in this game belongs to those who are willing to look foolish for a while in order to be solvent when it matters. I'm not alone in this. When you look at recent regulatory filings, what you see is a quiet but unmistakable shift in how the largest pools of capital are positioned. This isn't some coordinated conspiracy. These investors don't sit in a room and decide together, but they're all reading the same balance sheets, watching the same debt levels, and arriving at similar conclusions about what prudence looks like right now. Ray Dalio has been talking publicly about debt cycles and the risk of currency debasement. His fund, Bridgewater, has reduced equity exposure and increased positions in gold and inflation-protected assets. Stanley Druckenmiller, who built his reputation on macro calls, has been vocal about his concerns over valuation and fiscal sustainability. George Soros' fund has trimmed U.S. equity holdings. These aren't small retail investors reacting to headlines. These are people who have survived multiple cycles, who have access to research teams and data most people never see, and who are acting on what that data is telling them. When you dig into the 13 F filings that institutional investors are required to submit quarterly, the pattern becomes clear. Throughout late 2024 and into early 2025, there's been a measurable rotation. High multiple growth stocks, the kind that require perpetual optimism to justify their prices, have been quietly sold. In their place, you see increases in dividend-paying value stocks, short-duration treasury bonds, and alternative assets like precious metals and real estate investment trusts that hold hard assets, not leveraged commercial properties. Family offices, the private wealth management structures used by billionaires and multi-generational fortunes, have been even more aggressive. These aren't public entities, so their moves don't show up in filings, but the wealth advisors and custodians who serve them have reported a pronounced shift. Allocations that were 70% equities 2 years ago are now closer to 50% or even 40%, with the difference moved into cash equivalents, commodities, and in some cases, outright short positions on sectors they believe are overextended. The timing here matters. Most of this repositioning didn't happen in a panic. It happened methodically, beginning in the fourth quarter of 2024, well before any mainstream discussion of a 2026 risk materialized. That's the hallmark of institutional money. It doesn't wait for the news to confirm the thesis. It acts on the thesis and watches to see if the news catches up. Now, you might hear the standard explanations: portfolio rebalancing, profit taking after a long run, tax optimization. And sure, some of that is always happening. But when you see this kind of synchronization, when the scale of the shift is this pronounced, and when it's happening while the major indexes are still within a few percentage points of all-time highs, you have to ask a deeper question. What are they seeing that would justify stepping back now at what appears to be the height of the party? The surface narrative right now is one of resilience. The economy has navigated higher interest rates without collapsing. Unemployment remains relatively low. Corporate earnings, while slowing, haven't crashed. The Federal Reserve has signaled it might be done tightening. On paper, these are the ingredients for continued stability, maybe even another leg higher in risk assets. But the people moving billions of dollars aren't looking at the surface. They're looking at the stress fractures underneath, and those fractures have been widening quietly while the headlines stayed optimistic. This divergence between what the smart money is doing and what the broader market believes is not new. It's a pattern I've seen repeat itself with uncomfortable regularity over 7 decades. The wealthy, the institutional allocators, the people running serious capital, they have an information advantage. Not because they have inside information in the illegal sense, but because they have resources, access, and incentives that retail investors simply don't. That gap, that structural difference in how information flows and gets acted upon is what I want you to understand next. Because once you see how the game is actually played, the current positioning makes a lot more sense. And it raises a question that should matter to anyone with money at risk. If they're getting defensive now, what do they see coming that the rest of us are still being told not to worry about? The word reset gets thrown around a lot these days, and I understand why people might roll their eyes when they hear it, but it sounds dramatic. It sounds like the kind of language that sells newsletters and generates clicks. But when I use that term to describe what might be coming in 2026, I'm not trying to be theatrical. I'm describing a confluence of measurable pressures that are building in the system right now and that are likely to reach a critical point within that time frame. Let me walk you through what I'm seeing, because these aren't predictions. They're observations about known events and structural realities that are already in motion. First, there's the federal debt ceiling. In mid-2026, the United States will once again hit the statutory limit on how much the government can borrow. Now, we've been through this dance before. Congress eventually raises the ceiling, often at the last possible moment, and the machinery keeps running. But each time we go through this, the underlying debt keeps growing, the political theater gets more intense, and the margin for error gets thinner. The national debt is now above $34 trillion. That's more than 120% of GDP, a level we haven't sustained since the immediate aftermath of World War II. The difference is that after the war, we had a growing economy, a young workforce, and room to expand. Today, we have an aging population, slower structural growth, and a political system that can barely agree on keeping the lights on. The debt ceiling fight in 2026 will happen against that backdrop, and markets hate uncertainty about whether the U.S. government will be able to meet its obligations. Even if it gets resolved at the last minute, the disruption to confidence, the spike in short-term borrowing costs, and the signal it sends to foreign creditors all matter. Second, there's the commercial real estate maturity wall. Over the course of 2025 through 2027, roughly $1.5 trillion in commercial real estate loans come due. These are loans that were made years ago when interest rates were near zero and property values were rising. Now, many of those properties, especially office buildings, are worth significantly less than they were. Occupancy rates in major cities remain below pre-pandemic levels. Remote work has permanently reduced demand for office space. At the same time, the cost of refinancing those loans has gone up dramatically because interest rates are 3 or 4 times higher than when the original loans were written. What happens when a borrower can't refinance and can't sell the property for enough to pay off the loan? Default. And when defaults start to pile up, the banks and investors holding those loans take losses. Regional banks are particularly exposed here. We've already seen stress in that system in 2023 with Silicon Valley Bank and others. This commercial real estate wave has the potential to create a second, slower-moving banking stress that grinds on for quarters. Third, there's corporate debt refinancing. It's not just real estate. Corporations across the economy took advantage of low rates to borrow heavily over the last decade. A significant portion of that debt is coming due in the next 18 to 24 months, and it will have to be refinanced at much higher rates. For companies with strong cash flow and solid balance sheets, that's manageable, if painful. For companies that were already stretched, that were relying on cheap money to keep rolling over their obligations, the math starts to break down. Higher interest expense eats into profitability, reduces investment, and in some cases forces restructuring or bankruptcy. Fourth, there's quantitative tightening. The Federal Reserve spent years pumping liquidity into the system through bond purchases that inflated asset prices and kept borrowing costs low. Now they're doing the opposite. They're letting their balance sheet shrink pulling liquidity out of the system. That process is still ongoing, and it acts like a slow drain on the pool of money available to chase assets. Less liquidity generally means lower valuations, especially for the most speculative corners of the market. Fifth, there's the political calendar. 2026 is a midterm election year in the United States. Historically, that creates uncertainty and reduces the willingness of politicians to take unpopular but necessary economic measures. If something breaks in the economy or the markets during an election cycle, the ability to respond quickly and decisively is compromised. Everyone is calculating how their actions will play in their districts, not just what's best for the system as a whole. And finally, there's the historical pattern. Major market corrections often happen 18 to 24 months after the Federal Reserve finishes a rate hiking cycle. The effects of tighter monetary policy work with a lag. Businesses that seem fine initially start to feel the pressure. Consumers who maxed out their credit when times were good start to pull back. The economy, which looked resilient at first, begins to slow more than expected. The last rate hike in the most recent cycle was in mid-2023. 18 to 24 months from that point puts the danger zone squarely in late 2025 and into 2026. Now, none of these factors in isolation is necessarily catastrophic. Debt ceilings get raised, some loans default, but the system absorbs it. Corporate debt gets refinanced, even at higher rates. The Fed has managed quantitative tightening before. Elections come and go. But when you layer all of these pressures on top of each other, when they converge in a relatively narrow window of time, the cumulative stress becomes something different. It's not one crack in the foundation. It's multiple cracks appearing simultaneously. And the question becomes whether the structure can handle the combined weight. What sophisticated investors see when they look at this convergence is fragility. They see a system that has very little margin for error, very little room for unexpected shocks, and very few policy tools left that haven't already been exhausted. Interest rates are higher than they were, so the Fed has some room to cut if things break, but not nearly as much as they had in previous cycles. Fiscal policy is constrained by the debt load and political gridlock. The ability to simply spend our way out of trouble the way we did in 2008 or 2020 is much more limited now. So when you hear the term 2026 reset, this is what it refers to. Not some vague conspiracy or apocalyptic fantasy, but a very concrete and measurable convergence of economic and financial pressures that create conditions similar to what we've seen before previous major corrections. It's a time when the assumptions that have held for the last few years, the assumptions that have kept asset prices elevated and confidence high, will be tested in a serious way. And the question that matters for anyone with capital at risk is this: if that test comes, if those assumptions prove too optimistic, will you be positioned to weather it, or will you be caught extended, leveraged, and without options? That's the calculation the wealthy are making right now. They're not trying to predict the exact day or the exact trigger. They're simply acknowledging that the conditions are set for something to give, and they're making sure they're not the ones left holding the bag when it does. I've been watching markets for more than 7 decades now, and if there's one thing I've learned, it's that this exact pattern always appears before the serious breaks. Wealthy investors quietly repositioning while the broader market stays optimistic. It happened in 1987. It happened in 2000. It happened in 2008. And it's happening again right now. In the summer of 1987, institutional money was already moving to the sidelines while retail investors kept buying. By August, the smart money had significantly reduced equity exposure. The indexes kept climbing through early October. Then, in a single day, the market dropped more than 20%. The people who survived that weren't the ones with the best market timing. They were the ones who had already decided that the risk-reward didn't justify staying fully invested at those levels. The dot-com bubble followed a similar script. By late 1999, George Soros and I had largely avoided technology stocks. We were openly skeptical about valuations that required perfection. The media mocked that caution. Retail investors piled in, convinced that internet companies would rewrite the rules of profitability. The NASDAQ peaked in March 2000 and then lost 78% over the next 2.5 years. The wealth transfer during that period was extraordinary. Those who had stayed patient and liquid were able to buy incredible businesses at fractions of their peak prices. 2008 was perhaps the clearest example. By the fourth quarter of 2007, people like John Paulson and Michael Burry had positioned themselves for a housing collapse. They weren't guessing. They had done the work, looked at the mortgage data, understood the leverage in the system, and concluded that the math didn't hold. Meanwhile, CNBC and most of Wall Street remained bullish well into 2008. Bear Stearns collapsed in March. Lehman fell in September. By the time the average investor understood what was happening, the S&P had already lost more than half its value from the peak. In each of these cases, there was a lag, a gap in time between when institutional money started getting defensive and when the market actually broke. That lag ranged from 6 months to 18 months. During that window, it was easy to feel foolish for being cautious. The people still in the market kept making money. The narrative remained positive. But that gap is precisely the window that separates those who preserve capital from those who lose it. The question that should matter to anyone watching this unfold is straightforward. Why does that lag exist? Why is there always this gap between when sophisticated money gets cautious and when the market actually turns? The answer tells you something fundamental about how information flows in this system and who gets to act on it first. The wealthy have structural advantages that most people don't fully appreciate. It's not insider trading in the illegal sense. It's access, resources, and incentives that create an information edge that compounds over time. Start with direct access to company management. If you're running a billion-dollar fund or a major family office, you get invited to private investor conferences where CEOs and CFOs speak more candidly than they do in public earnings calls. You hear the tone, the hesitations, the things they emphasize and the things they gloss over. That texture matters. Then there's the research infrastructure. A serious institutional investor employs teams of analysts whose only job is to stress test scenarios and model risks. They run thousands of simulations on what happens to portfolios under different conditions. They track obscure data points that don't make headlines but signal stress building in the system, credit default swap spreads, repo market behavior, the velocity of money moving through the banking system. These teams cost millions of dollars a year to maintain. That's not accessible to someone managing their own retirement account. There's also proprietary data access. Prime brokers, the large banks that facilitate trading for hedge funds and institutions, provide their biggest clients with aggregated data on margin levels, short interest, and positioning across the market. They can see when leverage is building, when certain sectors are getting crowded, when retail investors are borrowing heavily to buy stocks. That real-time sentiment data gives them a read on fragility that public investors don't have until it's too late. And then there's the incentive structure. A fund manager or family office advisor is judged on risk-adjusted returns over the long term. Preservation of capital is part of the mandate. They're not trying to squeeze out every last percentage point of upside. They're trying to avoid catastrophic drawdown. That mindset naturally leads to earlier caution. Contrast that with the incentives facing retail investors. Most people are consuming financial media that makes money from advertising, and advertisers want bullish sentiment because that drives trading activity. The message is almost always optimistic by default. By the time mainstream outlets start warning about risk, institutions have already repositioned. It isn't just the big dashboard numbers that worry me. It's what I see when I look at everyday behavior in the real economy. Behind every chart about valuations or debt, there are families trying to make rent, keep up with car payments, and put something away for the future. Right now, too many of those families are running out of room. Savings that were built up during the pandemic have largely been spent. Credit card balances are at record levels. Delinquencies on cards and auto loans are climbing. Wages have risen, but prices rose faster, and that gap has been quietly filled with borrowed money. For a while, that can keep the machine moving. Stores stay busy, quarterly earnings look fine, and markets interpret that as proof of resilience. But you can't fund a lifestyle with a credit card forever. When the bill finally comes due, the pullback can be sharp. The wealthy see that strain building at the foundation of the consumer economy. They know that when the people at the base of the pyramid are forced to cut back, the effects don't stay at the bottom. They move up into revenues, profits, and eventually asset prices. The wealthy see an overvalued market sustained by a consumer base that simply cannot keep supporting it. When you combine stretched valuations with a tapped-out household sector, you're looking at a system that's far more fragile than the surface calm suggests. The question is, what happens when that fragility gets tested? Let me put some numbers to that. Recent data shows that roughly 60% of American households are living paycheck to paycheck. That's not just low-income families. That includes middle-class households with what used to be considered stable incomes. Credit card debt has crossed the $1 trillion mark. Delinquency rates on auto loans have climbed to levels we haven't seen since the financial crisis. The savings rate, which spiked during the pandemic when people couldn't spend and stimulus checks were flowing, has collapsed back to pre-pandemic lows. What kept consumer spending resilient over the past couple of years wasn't rising real incomes. It was the drawdown of those pandemic savings and the willingness to take on more debt. But savings can only be spent once, and debt capacity has limits. When a household is already carrying maximum credit card balances and the car payment is stretching the budget, there's no room left to absorb another shock, whether that's a layoff, a medical bill, or just the cumulative weight of higher prices that never came back down. The wealthy watch this consumer data closely because they understand the chain reaction. When the consumer pulls back, corporate revenues fall. When revenues disappoint, earnings estimates get cut. When earnings fall short, stock prices reprice lower. And when stock prices fall, the wealth effect reverses. People feel poorer, they spend even less, and the cycle feeds on itself. That's the mechanism that turns a correction into something more serious. And that's why the current positioning of sophisticated money makes sense. They're not predicting the consumer collapses next month. They're recognizing that the margin for error is gone, and when something does give, the cascade could be swift. So what are the wealthy actually doing about all this? Let me walk you through the specific moves, because these aren't abstract strategies. These are observable portfolio shifts that show up in regulatory filings and can be tracked if you know where to look. The most obvious move is the one I've already mentioned, raising cash. At Berkshire, we're sitting on more than $325 billion in cash and short-term treasury bills as of the third quarter of 2024. That represents roughly 28% of our total assets, well above our historical average of 10 to 15%. That's not because I've suddenly lost the ability to find businesses worth owning. It's because at current prices, the margin of safety that I require simply isn't there for most opportunities. Other large investors are doing similar things. Regulatory filings show significant increases in money market fund assets and short duration treasuries across institutional portfolios. They're not earning much on that cash, especially after inflation. But the point isn't to maximize return right now. The point is to preserve optionality so that when prices become more reasonable, there's capital available to deploy. Second, there's been a measurable rotation out of high multiple growth stocks and into value-oriented dividend payers. You can see this in the 13 F filings that hedge funds and large asset managers file quarterly. Positions in speculative technology names, the kind trading at 50 or 100 times earnings with no clear path to profitability, have been trimmed. In their place, you see increased holdings in companies with stable cash flows, reasonable valuations, and dividends that provide some return, even if the stock price goes nowhere. Third, gold. I've never been a big believer in gold as an investment because it doesn't produce anything. It just sits there. But I understand why people buy it when they're worried about currency debasement and fiscal irresponsibility. Recent data shows significant inflows into gold ETFs and increased buying of physical gold by central banks and family offices. That's a hedge against the risk that governments face with unmanageable debt loads ultimately resort to inflating their way out of the problem. Fourth, there's been an uptick in the purchase of put options, which are essentially insurance against market declines. Large institutional investors have been buying protection, particularly on major indexes. That shows up in options market data as elevated put-to-call ratios and increased implied volatility. These aren't speculators betting on a crash. These are prudent managers protecting portfolios against tail risk. Fifth, some of the more aggressive managers have taken outright short positions, particularly in sectors they view as overextended. Commercial real estate investment trusts, for example, have seen notable short interest because of the maturity wall I mentioned earlier and the structural decline in office demand. Certain consumer discretionary retailers that rely on continued debt-fueled spending have also attracted shorts. The common thread across all of these moves is defensive positioning. The wealthy aren't trying to squeeze out the last 10% of upside in a bull market that's already run for years. They're making sure that when the tide goes out, they're not the ones caught swimming naked, to borrow a phrase I've used before. They're building liquidity, reducing leverage, buying insurance, and in some cases positioning to profit from the decline they see coming. I've watched enough market cycles to know that nobody can predict the exact timing of when things will break. Markets can remain irrational longer than most people can remain solvent. That's an old line, but it's true. I can't tell you whether 2026 will be the year or whether the system limps along for another 12 or 18 months beyond that. What I can tell you is that the conditions are set, the risks are measurable, and the people managing serious capital are acting as if preparation matters more than prediction. The current environment reminds me of something I learned early in my career. In investing, it's not about being right on timing. It's about being positioned so that when you're eventually proven right, you're still around to benefit from it. The inverse is equally true. If you're positioned as if nothing can go wrong and something does, the damage can be permanent. Wealth built over decades can evaporate in months. That asymmetry is what drives the defensive positioning I've described. For someone with significant capital, the upside of staying fully invested if the market goes up another 10% is nice, but not life-changing. The downside of being fully invested when it drops 40 or 50% is devastating. The math of loss is brutal. If you lose half your money, you need to double what's left just to get back to even. That takes time. And for many people, particularly those nearer in retirement, time is the one resource they don't have. So the wealthy are making a calculated trade. They're giving up some potential upside in exchange for protection against significant downside. They're ensuring that if the reset comes, they have the liquidity and the stability to not just survive it, but to take advantage of it. Because here's the part that often gets overlooked. The real money in investing isn't made by riding bubbles to their peak. It's made by having capital available when great assets go on sale at distressed prices. In 2008 and 2009, while most investors were panicking and selling, the people who had preserved cash were able to buy high-quality stocks and bonds at generational lows. Entire businesses that had been worth billions were suddenly available for pennies on the dollar. Real estate that had been overpriced for years could be bought at fractions of replacement costs. The wealth transfer that happened during that period was staggering. The rich, who had been cautious going in, became vastly richer coming out. The middle class, which had been fully invested and often leveraged, took losses they never fully recovered from. That pattern repeats every cycle. It's not a conspiracy. It's just the mechanical result of who has optionality and who doesn't when the music stops. For someone reading this who doesn't have billions of dollars to deploy, the principles still apply, just at a different scale. You can't control what the market does. You can't control when or if a correction comes, but you can control your own exposure. You can decide whether to be fully extended in risk assets at elevated valuations or whether to hold some cash, reduce leverage, and make sure you're not in a position where a 20 or 30% decline forces you to sell at the worst possible time. That's not market timing. It's risk management, and it's the same logic that's driving the behavior of the wealthiest investors in the world right now. They see the same data you can see if you look for it. They just have the discipline and the resources to act on it without worrying about missing out on the last bit of upside. The 2026 reset, if it comes, won't announce itself in advance. There won't be a clear signal that tells you to get out today. By the time it's obvious to everyone, it will be too late to reposition without taking losses. The edge, the only real edge available to individual investors, is the willingness to be prudent before it feels necessary. To accept that looking cautious for a while is a small price to pay for being prepared when it matters. I don't know if they'll be proven right about 2026 specifically, but I do know that the setup we're in now, the combination of high valuations, high debt, exhausted consumers, and limited policy tools, doesn't end quietly. It ends with a repricing. And when that repricing comes, the people who prepared won't get rich from it, but they won't get destroyed either. They'll preserve what they have, and they'll have the chance to build again from a position of strength. That's the secret, if there is one. It's not about knowing the future. It's about respecting uncertainty, managing risk, and having the patience to wait for the opportunities that only come when everyone else is forced to sell.